Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, and joining us today to discuss late-stage venture capital investing is Kevin Moss, President and Portfolio Manager at Liberty Street Advisors. Welcome, Kevin.
Hi, James. Thanks for having me.
It's a pleasure to have you. Kevin, as a manager, how do you establish and maintain deal flow? Do deals predominantly come to you, or do you and your team seek them out?
James, we've seen a lot of deal flow over the past couple of years. They predominantly come to us. We've seen over $2 billion in deal flow just in the last year. If there's a particular company that we're interested in, we will try to seek it out. But I have to say that most of the deals do find us.
Within the life cycle of a company, can you define for us where late stage venture capital starts and finishes?
Well, if you want to, look at it from a revenue profile, there could be a company that's raising capital for the first time, but you may not consider it early stage or look at it as a late stage company. Typically, when we look at late stage, it's a company that has at least $50 million in revenue. It's growing anywhere between 30 to 50% top line. It has investors around the table that are VC, some of the top VC-backed companies, and they've done a series of rounds of financing, usually round A, B, or C. When you hit the C round, it's typically a later stage company.
Kevin, what are the main sectors you see in your universe? Is it things that people might expect, such as technology and clean energy? And is there an element of fashion in the kinds of deals that come to you at various times?
When we look at sectors, James, we really think about all sectors having some innovative area to it. Technology spans all sectors if you think about it today. So even if you look at a company or sector like healthcare, technology is innovating there as well. So you have digital health, you have education technology. So some of the sectors that you wouldn't typically think of being technology led, they really are. It spans all sectors. So we look at all these different sectors. They must be innovative. They must be disruptive companies. Cybersecurity, enterprise software, the private space economy. We probably have about 17 or 18 different sectors within our current portfolio.
So do you have that template of industry sectors that you're always looking at and that you like to follow? Or are you more concerned with the growth prospects of the individual business rather than filling out your diversification matrix?
It's a little bit of both. They really has all the different due diligence areas need to be checked when we look at a particular company. But if we're really building out a diversified portfolio, we do try to get exposure to a bunch of different sectors. Sectors do ebb and flow over time. And there could be a sector like ad tech, which was a dead sector for a number of years and really came to life during COVID. So we really want to be diversified, not just by company type, but by sector as well.
Kevin, what is the time frame normally for you and your team to start assessing a company, start your due diligence, and move to an investment decision? And is that time frame always relatively the same, or do you have to sometimes be a little bit quicker to get into the deal?
Two parts to that question, James. Our time frame is probably a lot quicker than most. We run an evergreen strategy, so we always have cash on hand so we can move pretty quickly. Our due diligence process tends to take anywhere between 2 to 3 weeks. However, there are times when you're seeking out a very popular company. It's a crowded space. There's a lot of other high quality investors looking for the same investment. And so you have to move just a little bit quicker. So we've been able to make investments as soon as a week into due diligence, primarily because we've been watching the company already and we've done a lot of work. But yes, I'd say on average, call it 3 to 4 weeks. but we have moved much quicker than that when we needed to.
What's it feel like to be on your own in a deal? Is that something that you really don't like to do, to not have any of your peers also involved?
We don't typically do that. Not that we don't trust ourselves. We think we're a smart group, a smart team, but we really like to see other smart investors around the table. We're not going to see us typically lead a deal. We want to see investors that are already there, that are continuing to invest from round to round. That's how we approach it. We're getting a lot bigger, however, and we've been asked to lead deals and be on our own, but we're not quite there yet, James, for that. We feel much more comfortable when we have a number of investors around the table with us.
When it comes to exit and monetization, Kevin, is it more likely to be an IPO than a trade sale, or vice versa? And on the back of that, do each of those types of exit, do they wax and wane in terms of being the more popular option?
I'd say that historically speaking, in private equity, you're going to see a trade sale 2/3 of the time. You'd be surprised how many companies actually get bought before they ever enter the public market. For our portfolio, though, it's been about 50-50, and it does wax and wane over time. There are times when the public exit environment is open and is active, and then there's times when it's not. And in those cases, usually they counteract each other. Because the public exit environment begins to shrink, in many cases, the trade sale or the M&A environment grows. And so we don't time these things, obviously. They do ebb and flow or wax and wane over time, but there's always a way that some of our companies will have an exit.
And in the IPO style of exit, Kevin, obviously you have your lockups and your escrow periods, but do you ever actually stay in after those periods, after the time you can get out? If you really, really like an investment, do you ever stay in as an equity investor in the listed company?
This particular strategy that we run, we buy our companies when they're private, all of our companies when they're private. They mature in the portfolio, James, and then we have an exit. If it's a public exit, typically it comes with a lockup period of 6 months. Once that lockup expires, at that point, we would typically look to realize our gains. We're not going to sell the position day one. There's a lot of noise that goes around with lockup expiration, but we would probably exit the position anywhere between 60 to 90 days after lockup expiration. Not in every case. There's no actual requirement for us to exit the position, but the real strategy that we're running is buying private, mature, exit, realize the gains.
And that time frame of from the first time you look at a company to that exit, after when you're allowed to on an IPO scenario, what's a typical length of time that whole involvement with the company takes?
We expect a time period of between 2 to 4 years. That's what I would say on average we've seen over the past 10 years that we've been doing this in late stage venture. Of course, we've seen exits happen much sooner and we've seen exits happen much later, but I'd say on average, it's been about 2 to 4 years.
Thanks very much, Kevin. This has been In Depth with Kevin Moss, President and Portfolio Manager at Liberty Street Advisors. Been a pleasure talking to you, Kevin.
Thanks, James. Thanks for having me.